Have you ever wished you had financial x-ray vision? You know, a way to look right through a company's slick marketing and see what's really going on inside? Well, it turns out there's a tool for that. And in this explainer, we're going to pull back the curtain and demystify it completely.
I mean, think about it. Behind all the flashy product launches and the confident press releases, how do we really know if a company is solid? How can we tell the difference between a business that's built on a rock-solid foundation and one that's, quietly taking on water? That's the big question, right?
And the answer, lucky for us, starts with one single, incredibly powerful document. But here's the key. It's not a movie. It doesn't show you the company's performance over a whole year. Nope, it's a photograph, a precise snapshot of its financial health at one specific moment in time.
And that snapshot has a name. It's called the balance sheet. Or, if you want to get formal, the statement of financial position. And its job is actually pretty simple, but it's also profound. It shows you everything a company owns and everything it owes, all on a single day.
So the balance sheet basically breaks down a company's entire world into two big ideas. On one side, you have what's called its resource structure. That's all the valuable stuff it has. And on the other side, you see its financing structure, which is just how it paid for all that stuff. Did it borrow the money, or did it use money from its owners?
Okay, so how does this actually work? How can one piece of paper capture all of that? Well, it's all held together by this beautifully simple and honestly really elegant piece of logic.
It all comes down to a perfect balance. And when I say perfect, I mean it. This isn't just a goal or a nice to have. It's a mathematical certainty that is baked into the very fabric of accounting. It has to balance. And here it is, the whole thing in one line. The fundamental accounting equation. Assets equal liabilities plus equity. It just means that everything a company owns, its assets, had to be paid for somehow. And there are only two ways. Either you borrowed the money, which is a liability, or the owners put up the cash, which is equity. It's that simple. And understanding this one idea unlocks everything. And this is the perfect way to think about it. Imagine you buy a house. The house itself, that's your asset. The giant loan you got from the bank, that's your liability, the mortgage. And that down payment you scrape together, your own skin in the game, that's your equity. See? The value of the house is equal to the bank's claim on it plus your claim on it. It just makes sense.
So let's dive into that first piece of the puzzle, assets. What do we mean by that? Well, these are the economic resources that a company controls. It's all the stuff that's expected to provide some kind of future economic benefit. Everything from cash in the bank, to a giant factory, to something you can't even touch, like a patent. But here's the thing. Not all assets are created equal. Accountants split them into two main buckets, and it's all based on one simple idea: time. Current assets are your short-term stuff, things the company plans to turn into cash or use up within about a year. Non-current assets? Well, those are the long-haul players, the foundation the business is built on for years to come. So if you look at current assets, you're really seeing the lifeblood of the company's day-to-day operations. You've got cash, of course. You've got receivables, which is just a fancy way of saying IOUs from your customers. You've got inventories, all the products sitting on the shelves, and then things like prepaid expenses, say paying your office rent a few months in advance. And then you've got the non-current, the long-term assets. This is the big stuff, the factories, the machinery, what accountants call property, plant, and equipment, or PP&E. It also includes intangible things, stuff you can't physically touch, but that has massive value, like a patent or copyright. But this brings up a really interesting question. Think about it. If a company bought a factory, say 20 years ago, what value goes on the balance sheet for it today? Is it what they originally paid? Or is it what they could sell it for right now in today's red-hot real estate market? This is probably one of the most misunderstood things about the balance sheet. And the answer is a core accounting rule called historical cost. The balance sheet does not show you the current market value for most of these big long-term assets. It shows you what the company paid for them way back when. So that factory is on the books for its original price. This is a huge, huge limitation to keep in the back of your mind. Okay, let's flip over to the other side of that equation. We've talked about what a company owns. Now let's talk about what it owes. These are the liabilities. These are the claims that outsiders, people like banks and suppliers, have on all those assets we just talked about. The official definition sounds a little dense, but it's simple, really. Liabilities are just a company's obligations. It's their debts, their bills, all the promises they've made to pay someone else in the future. So if assets are what the company has, liabilities are other people's claims on that stuff. And just like we saw with assets, liabilities are also split by time. Current liabilities are the bills that are due soon, usually within the next year. These are the ones that keep managers up at night. Non-current liabilities, on the other hand, are the long-term debts like a 30-year bond that the company doesn't have to worry about paying off right away. And you'll see some familiar ideas here. You've got accounts payable. That's the money the company owes to its suppliers. You have wages payable. Got to pay your people, right? Then there are short-term bank loans, and the really big ones, like long-term bonds or pension obligations, which can stick around for decades. Okay, so we've covered what a company owns, the assets. We've covered what it owes to everybody else, the liabilities. So the last piece of the puzzle is what's left over. And that leftover bit, that belongs to the owners. That's equity. Equity is often called the residual interest. And here's the best way to think about it. Imagine you took the company and had a giant garage sale. You sell off every single asset, the factories, the computers, everything. You take all that cash and you pay off every single liability, every bank loan, every supplier. The pile of cash that's left over in the end, that's equity. It's the owner's piece of the pie. All right, so we've seen how the balance sheet is this incredible tool for getting organized. It's super powerful, but, and this is a really big but, to truly get it, you have to understand its limits. We have to talk about its blind spots. And honestly, if you take away only one thing from this entire explainer, let it be this. The source material could not be more clear on this point. The balance sheet does not tell you what a business is worth. The book value you calculate from the balance sheet is not the same as its market value in the real world. So why not? I mean, why isn't it the true value? Well, there are a few huge reasons. First, some of the most valuable things a company has, like an amazing brand name or a world-class team of engineers, don't even show up on the balance sheet. We already talked about how other big assets are stuck at their historical cost, not what they're worth today. Plus, accountants have to make a ton of judgments and estimates all over the place. It's not as black and white as you think. So in the end, the balance sheet is an absolutely essential tool, but it's an incomplete picture. It's a static photograph of a living, breathing, dynamic business. It's great at answering the question, what's the situation right now, but it can't tell you, how did we get here? Or more importantly, where are we going? To see that, well, for that, you need to look at the rest of the financial photo album.